Welcome to Taking Stock for the week ending 28th of November 2025. My name is Jason Yin, and joining me today is my colleague Charlie Song. Welcome back to the seat, Charlie.
Great to be here, Jace.
As always, the information we provide is general in nature and doesn't take into account your personal circumstances. Shares are volatile, and past performance is not a reliable indicator of future performance. Well, Charlie, let's kick off with some of the research that caught our eye this week. There's been a lot of chatter about inflation, especially here in Australia, and what it means for markets heading into 2026.
Yeah, and what really stood out was that Australian inflation expectations are creeping higher, whilst the US and Europe expectations continue to ease. The chart on screen shows it clearly. Germany and the US are softening, whilst Australia might be tightening up. It's becoming a real divergent story.
And because of this divergence, Charlie, most central banks are shifting to a bit of a wait and see mode after the big rate cut cycle that we saw in 2025. Markets are pricing in something very different for the RBA and the Bank of Japan, though, and they're the only two major central banks where further tightening is still on the table.
Yeah, just a reminder for our clients, the BOJ have been reducing rates for decades. So this
Hmm.
is the first time in a very long time that they'll be increasing their rates. It's a pretty interesting contrast. When you look at Australia, you've got sticky services inflation, a still strong labor market, and surprisingly resilient household spending despite those higher rates. So the RBA doesn't have that ability to cut rates like the US or the European Union does.
Yeah, and from the equity perspective, Charlie, that macro backdrop is starting to show up in market structure as well. And one of the big themes playing out is the rotation away from large caps and into small caps, which have quietly been outperforming since mid 2025 after nearly 3 years out in the wilderness.
Yeah, it seems investors are finally looking down at the market cap spectrum again, and
Mm.
they're trying to find a smaller bargain. If inflation stays sticky and the RBA remains hawkish, it does tend to favor domestically leveraged small caps, businesses with pricing power, less foreign exposure, and more direct sensitivity to the local economy.
Which I guess is pretty good news for Stock Doctor members since our universe leans heavily towards quality small and mid caps as well. So heading into 2026, we've got rising inflation expectations at home, a central bank that may tighten further, and also a market that's already rotating towards smaller companies. These are not really the narratives that anyone was expecting 6 months ago, right?
No, it wasn't, Jason. And it means that we think stock selection matters again. The
Mm.
winners and losers will be driven by fundamentals, not changing macroeconomics.
Well said, well said. Now, moving on to company news, the first cab off the rank is IVE Group, which issued a guidance update at its AGM. And based on the share price reaction, it seems like the market wasn't really that thrilled. What's happening here?
Yeah, no, it wasn't, Jason. And IGL downgraded earnings guidance, pointing to a softer demand environment in print and marketing services. We look at the US listed peer, Simpress, as a good guide for what's happening in the industry overall. Simpress is only growing organically at around 3%, with net margins at around 3%. So IGL is a little higher than that. They've got about 5.5%, is where their net profit margin is sitting at. But
Mm.
that is historically quite high for this business. I think what it reinforces is that the printing industry is a mature, low margin industry. Volume growth is hard to find and pricing power is quite limited. We don't think these businesses scale and have the unit economics that digital businesses do. Having said that, IGL can produce cash and has produced quite a bit of dividend. We think the dividends will continue, but the runway for those dividends will be modest.
Right, and that's a pretty interesting dynamic. So essentially, earnings may still grow modestly in FY26, and the dividend remains relatively intact. But investors are reframing some of the longer term growth expectations for this company. And another one on the radar this week is Lovisa, which sold off following its AGM update.
Yeah, and the market did seem a bit spooked about concerns around that like-for-like sales figure. So the headline sales growth was actually quite strong for the company. We saw global sales up 26%. That's an
Mm.
acceleration from the 14% we saw in FY25. But a large component of that was store rollout growth. And like-for-like sales remained, I guess, modest at 3.5%. So we do think that those concerns are driven by the lower like-for-like sales figure. And if those like-for-like sales figures improve, that the sentiment surrounding the company will improve. But for now, we do think the reaction seems a bit overcooked. A reminder that retailers like Lovisa make most of their money in the key Black Friday and Christmas sales period. So we don't think this number matters that much for the full year, nor does it matter that much for the long-term value of this business.
Yeah, in the retail game, Charlie, 2 months worth of trading can really make or break a year. So investors really need to be careful drawing conclusions from some of these early trends. Shifting our focus to the financials, Charlie, Bendigo Bank notified the market of a compliance breach. There were no specifics released, and the company flagged a continuous disclosure matter. What's happening here?
Yeah, so they've found a compliance issue, or Deloitte, who they've consulted, have found a compliance issue with under the Anti-Money Laundering and Counter-Terrorism Financing Act. Now, that
Right.
sounds bad, but they haven't provided any specifics, so we don't know what it is about, and that makes it hard to quantify, but we do think there probably are going to be some limited impacts to earnings maybe in the next year or the year after that. That's probably going to be with regards to system upgrades, additional hiring of compliance staff, and potentially a regulatory fine. We don't think that changes the long-term franchise, but it could soften dividend growth in the near term.
Interesting. Let's wait and see what happens here. We should probably touch on some of the corporate activity or takeover activity that we've seen this week, Charlie, and it's been a real bonus for members holding on to some of these names.
Yeah, there's a lot happening. Firstly, National Storage REIT got a takeover bid from a consortium of private equity investors.
Hmm.
That takeover bid was around 20-30% higher than when it was trading. It's now trading around that bid level. And it's a good example of a company with pretty strong earnings runway, trading below net asset value, being recognized by market participants.
Wow, and that's a pretty large premium, Charlie. And another big one that we saw was for the AUB Group, which is currently trading, I guess, disappointingly 10% below the offer price. Now, a spread like that usually suggests the market sees some form of deal risk, and this is probably similar to what we saw in the Santos situation earlier this year.
Yeah, and that's right. And we're not 100% sure the deal will go through, but we do think that the deal structure, the bidder's profile, and the lack of major regulatory barriers suggests that the probability of completion remains reasonably high. For investors, that 10% discount could represent a short-term event-driven opportunity.
And they surely need to understand some of the risks involved, Charlie. And then there's also IFM. The takeover process has finalized for this company, and the stock is now delisted. It's another example of corporate activity crystallizing some of the value that the market didn't originally see, particularly for companies whose earnings runway wasn't fully recognized yet. So interesting stuff
Yeah.
there.
It is. And overall, it's been a strong period for members who, if they've held NSR, AUB, and IFM, and it reinforces that in a higher rate environment, strategic buyers are still willing to pay, but they will only buy quality assets.
And under the microscope this week, we're looking at Fisher and Paykel Healthcare. A lot of investors compare it to ResMed, but the two operate in very different pockets of the respiratory market. So, Charlie, what does Fisher and Paykel actually do, and how does it differ to ResMed?
Yeah, so ResMed's predominantly a sleep apnea business. They make CPAP devices, masks, and home therapy products. Whilst Fish and Paykel is more of a hospital-driven business, and they're focused on respiratory support in acute and critical care. And they also do have a home care segment as well, but the hospitals are really the main driver of the business. And the demand drivers and competitive dynamics do differ meaningfully from ResMed.
And Fisher and Paykel also released its first half 26 results this week. Revenue was up 14% and earnings after tax was up 39%, which was a pretty strong result. Most of the momentum came from the hospital division, with global hospital activity normalizing and also consumables demand staying pretty robust as well. Margins also improved, Charlie. Freight cost ease, Mexico manufacturing efficiencies were observed, and also the company held pretty firm pricing, which supported a lot of the performance over this period.
Yeah, management did upgrade their FY26 guidance, which is something we haven't seen much post-COVID. The market
Mm.
responded well to that. Part of the backdrop is the US respiratory season. COVID cases are low, but flu activity remains elevated, supporting steady demand for respiratory therapies.
And one question that obviously keeps coming up, Charlie, is the tariff exposure. I mean, what's the latest around this juncture?
Yeah, the main issue doesn't seem to be tariffs on Mexico. The exposure seems to come from Section 301 tariffs on Chinese origin components, which are
Mm.
still used in some product lines. Not everything has transitioned to Mexico yet, where their goods do enter the US duty free. So some of those inputs for the business do still attract duties until that transition completes.
Mm.
Management expect about a 75 basis point, so 0.75% gross margin drag in FY26 because of this.
So the upgrade from management wasn't just purely because tariff have disappeared. It seems to have been driven by pretty strong demand and also disciplined execution all around, right?
Exactly. And whilst, in one way, the tariffs do remain a headwind to that gross margin, the fact that the core business is performing well is a good sign of resilience in this business. And
Mm.
we don't think tariffs are going to be there forever, do we, Jace?
Yeah, great points, Charlie. And final question. The share price seems to have trended sideways over the past year. What's our perspective in terms of its attractiveness at these current levels?
Yeah, we don't think the company trades cheaply. The share price has had a run hard over the past few years, and the market is already pricing in a clean recovery path. It's a great business, but you do need confidence in that outlook.
All right, Charlie, time for our question of the week. And this one is a pretty interesting one. One of our clients have asked, how does a high inflationary environment impact the stocks in my portfolio?
Yeah, the short answer is it depends on the type of business you own, Jason. High inflation tends to favor companies with the ability to increase their prices without losing customer demand. Think of
Hmm.
businesses like utilities, toll roads, software subscriptions that are really essential, and some consumer staples.
Right. And on the flip side, businesses that are more on the discretionary spectrum with high input costs or large wage bills could really feel the punch. And these could include retailers, building material companies, and also certain industrials as well, where margins could get a little bit squeezed.
Exactly. And high inflation often keeps interest rates elevated, which usually means lower valuation multiples for long duration growth stocks.
So the key here is knowing which businesses can raise prices, control costs, and also continue to deliver through an inflationary environment. And that's where a strong balance sheet and also consistent cash flow really do matter in these type of scenarios. Well, that's all we have time for this week, Charlie. Thank you so much for joining me.
No worries, Jace. And it was great to be here today.
Thank you. And for all our members, if you have any friends or family who might benefit from Stock Doctor, please feel free to share our link with them. Our growth comes from members like you, and we genuinely appreciate your support. And also, just a friendly reminder that being part of the Prime Financial Group means you also have access to our full suite of services, including wealth management, self-managed super fund administration, accounting, and also alternative or property investment opportunities to help diversify your portfolio. You'll find more details in the Prime section of Stock Doctor. See you next time on Taking Stock.